All right, and so good morning again, and welcome to today's webinar, Managing the Battleground Issues and Lost Profits Analysis. I'm Danny Jacobs, legal editor of the Daily Record, and I'll be serving as the moderator and question asker. The control panel on the right of your screen has a space labeled Questions. If at any point during the webinar you have a question, please type it in there and I will ask it. We'll have time at the end for questions as well, but Zach has no problem answering them as he goes through his presentation. Today's webinar is sponsored by Ellin Tucker, a leading Baltimore-based CPA firm specializing in accounting, auditing, consulting, forensics, and valuation and tax services. As the fifth largest accounting firm in Greater Baltimore and a top 10 Mid-Atlantic public accounting firm, Ellin Tucker serves privately held businesses and their owners, as well as nonprofit organizations in the Greater Baltimore region and beyond. For more information, visit ellinandtucker.com. And leading today's webinar is Ellin Tucker's Zach Reichenbach. A Baltimore native, Zach is a principal in Ellin Tucker's Forensic Valuation Services Group and has been a member of the firm for nearly a decade. He is well versed in providing valuation and litigation services to clients, ranging from contract disputes to complex litigation. His specialty is preparing and defending damage claims in matters involving commercial damages and breach of contract. A graduate of Loyola University, Maryland, Zach has additional expertise in IP damages, including patents, trademarks, and trade secrets. And with that, I will turn the proceedings over to Zach.
Thanks, Danny. I appreciate it. Hope everyone out there can hear me clear. Feel free to ping in if I'm not coming across clearly or if I need to either talk louder or talk softer. But anyhow, thanks for the introduction, Danny, and thanks for everyone out there listening. I appreciate the time and the effort during everybody's busy day to listen in. As Danny said, I've been doing this for a number of years. My specialty is lost profits damages and other related type of calculations. At Ellin Tucker, our Forensic and Valuation Services Group is comprised of myself and my two partners, Larry Pullen and Chris Rosenthal. And if any time during this presentation you have a question or I didn't cover something, feel free to reach out to me personally. My contact information is in the slide deck that everyone was given. I'd be happy to answer any question that you might have or meet for coffee or lunch or whatnot, because our office is based in downtown Baltimore. At the end of the day, what I go through, I want to make it clear that there's no right or wrong in a lot of the methods and a lot of the descriptions I give today. I think in some cases there could be methods or other items that are better served or better used, depending on the facts and circumstances of each case. But I hope that what I tell you today gives you a little bit more insight in the type of things that we do at Ellin Tucker. So for an overview of what this presentation and this webinar is going to be about, I'm first going to start and go over what lost profits is, kind of go into the nuances of it, the type of things or elements that go into the calculation itself. And with that, I'll have a number of illustrations such as charts and tables and other slides that really kind of hone in the type of calculation and the type of analysis that we do. From there, I'll go into some common battleground issues that we face. A lot of times when we work for attorneys in a litigation matter, litigation setting, there's experts on both sides. So we might be working for the plaintiff or defendant's expert, and then there might be another expert on the other side. So there's typically a battleground issue where, in a lot of these cases, it comes down to 2 or 3 issues at play, and the winner, I don't want to call him winner, but the expert who typically succeeds is the one who has a more supportive and fact-based opinion and analysis. So but we'll go into that. I want to jump heavily into revenue projections, which is the first main issue, and then go into the second issue, which is variable versus fixed cost analysis. Really explain some of the different methods that we use and how 2 experts could come to very different opinions and total amounts, and how that could be a battleground issue in a lot of these cases. And then last, certainly go into how, as attorneys, how you guys can help experts like myself and my team. And I'll kind of touch on that as we go through the presentation as well. So let's just jump right into it. What is lost profits? In layman's terms, or the basic definition is that it is the impairment of cash flows that would have been earned by the subject company, but for the damaging event. So when it's all said and done, what would the company have done had this event or act never occurred? And that's what we're trying to quantify. And in the calculations that we're trying to quantify, we're trying to get to a number or an amount that would put the injured party back whole. And we're looking at it strictly from a profitability or from a cash flow standpoint with lost profits. Remember, lost profits in nature are temporary damages. So there's going to be a definitive start date and a definitive end date. I'll touch on this in a bit more later in the presentation, but there are other damage measures such as lost value, for example, that might or that is more permanent in nature. So if you're a litigator or have a client who might be going through litigation and you're trying to sort out the type of damages that your client might be faced with, figuring out whether it's a temporary damage or a permanent damage measure would certainly be something that we could consult with or talk with you about because there is a gray area between the two. But with our expertise, we've certainly done both in the past. Now, with any lost profits calculation analysis, we always think of it or do two different scenarios, take a two-scenario approach, and this is pretty common in the industry. The first being a but-for scenario, which considers the cash flows or profits the company would have earned but for the damaging event. So when you're thinking about this but-for scenario, we're kind of creating a narrative that we're in this hypothetical or imaginative world scenario where we're trying to understand what the company would have done had this damaging event or act never occurred. On the flip side, there's the actual scenario, which is a calculation of the cash flows and profits that the company actually did during that same time period. Now, this is cash flows that occurred after the damaging act, so most likely the cash flows and profits are most likely lower than what the company would have done but for the event. Now, I mentioned to you before that the damage period itself is temporary in nature, so there's going to be a definitive start and end date when it comes to lost profits. Now, at some point in a lost profits calculation, there's going to be a start date. And that start date, typically in our experience, has not really been disputed all too much. That's pretty objective. So you take the example of a breach of contract case. The parties in the litigation matter typically know when that breach of contract occurred. There's usually a pretty solid or hard date that everyone was aware of the act. If it's an infringement, a patent infringement, or a trademark infringement, there's usually a pretty clear-cut date as to when that infringement started. When it comes to some other type of cases like a defamation or a slander or an employment type case, it might not be as clear-cut, but it's usually pretty objective as to at least when the time period started or when the act occurred in that time. Now, on the other side, on the end date, this can be pretty subjective. In our experience, if experts are going to disagree on the length of the damage period, it's typically on the end date. And I say that, let's just take a breach of contract case, for example. In a breach of contract case, one expert might give an opinion as to the damages throughout the rest or the life remaining on the contract. So a contract could be 3, 5, 7 years remaining in length, and that first expert might calculate damages until that contract expires. Now, on the flip side, the other expert number 2, might go ahead and say, well, look, in this contract, there is a renewal option for an additional 3 years. So I'm going to make the assumption that the contract was going to extend to 3 additional years. So the second damages expert would have a damage period longer than 3 years. And it comes down to that, what's right, what's wrong, or what's more correct. And we see that a lot of times in our work, where one expert might make an assumption that the damage period is longer than the other, and that's not uncommon. If it's not a breach of contract case and you're trying to understand how long it would take for the company to be back whole again, that could be pretty subjective. If you're looking at cash flows and profits, you might get differing opinions between each expert. In our line of work, it's not uncommon to go out 20, 30, 40 years in our calculations. Now, anything out 20, 30 years is probably pretty subjective, but that length of damage period isn't uncommon in our line of work. The next slide, for example, I think is a great illustration of lost profits. And anytime that I'm doing a lost profits calculation, I like to refer to this type of chart because it helps put things in perspective in terms of the type of analysis that we're doing. The top line are the profits and cash flows in the but-for scenario. And in the bottom line, is the cash flows and profits from the actual scenario. And everything in between is what we're trying to compute, and that's damages or lost profits. Now, you can see somewhere in year 2 that the damaging event occurred. And that's the start date of the damage period. And you can see the actual cash flow drop substantially from year 2 to year 3. But as the length of the damage period goes on, you can see starting in around year 9 that the actual cash flows go back up to what the company would have done, but for the damaging event. And that's typically the end of the damage period. But when I do lost profits calculations, I like to refer to this type of chart because it helps put things in perspective from a visual standpoint as what we're trying to accomplish.
Zach, I had a question. What goes into the but-for cash flow projections that you have? How do you come up with the green line on the chart?
Sure. So when we're taking a look at the but-for scenario, there's a lot of different things that can go into it, but ultimately we're trying to figure out what the profits are that the company would have done, right? So you're trying to put yourself back in the position that you were just prior to the damaging event, and what did the company expect to do going forward over the next several years? We'll take a look at various financial statements, projections that the company prepared. We'll take a look at other financial information that might give some credence or some evidence as to revenue or expenses down the road. Those type of things that we would typically look at in a but-for calculation. I'll go into more of the nuance and the details in a minute. And there's certain ways we calculate those profits that might be different than general profit calculations in other areas. Now, lost profits can be both historical and in the future. So, if I'm sitting today's the date of the trial. A lot of times when we do our calculations, we use the trial date as the measurement date. So anything before the trial date is going to be historical lost profits. Anything after the trial date is going to be future lost profits. Now, when it comes to historical lost profits, you remember for the but-for scenario, you're trying to create this narrative, create this hypothetical scenario as to what the company would have done. So you're going to project what the company would have done had this damaging act never occurred. Even though this time period has already happened, you're still kind of putting yourself in the shoes as to what you thought you were going to do before this thing occurred. Well, in the actual scenario, you do have the actual financial statements, you do have the profit and loss statements and some other financial information for that time. So it's a bit easier to understand what the profits are in that actual scenario, and it's a bit more objective. And as with any historical loss profits calculation, there's going to be prejudgment interest. So I know the Maryland statutory rate, I believe, is 6%. So in the event that the jurisdiction or the trier of fact calls for prejudgment interest, you can get prejudgment interest on historical lost profits. Now, go ahead.
Sorry, we have a question. Bill Ash, are you there?
Is that Bill?
Bill, are you there? Oh, and if Bill can answer this question, we'll get to that when he can answer. Or Bill, you can write in your question in the question box, and I can answer that. Sorry.
Sure. No problem. In terms of future lost profits, it's what the profits are after the date of measurement or the date of trial. In the but-for scenario, you just continue along that trajectory as to what you thought you were going to do prior to the damaging event. That doesn't change all too much. The actual scenario will change a bit. And for the historical lost profits, you had financial statements and actual financial information which you can base your calculations on. Now that you're projecting out in the future for the actual, it's put yourself in the scenario as of the date of measurement, and what do you think you're going to do at this current level going forward? And that's the mindset that we take when trying to compute the actual scenario. And with any future lost profits calculation, we would have to present value those lost profits back to the date of trial or the date of measurement. We use a cost of capital or a discount rate. We have many different sources and studies that we use in our calculations that we opine to. This might be a battleground issue in certain cases because one expert might use a different method or source than the other expert. I can tell you in our experience, or at least in our work, we try to use 2 or 3 different methods and take the average of those 3 or 2 because it gives us more credibility and basis by using multiple methods. I mentioned that we typically present value future lost profits back to date of measurement or trial. That's typically under the ex post scenario, and that's commonly what we do probably the most. But there are instances and jurisdictions that call for the ex ante method, which would present value off future lost profits back to the date of the incident, even before the date of trial. So I know that depends on the jurisdiction. As counsel, please consult with us prior to us doing our work so we have a clear understanding of what we're supposed to do. I'm sure there's case law and stuff out there with each jurisdiction as to what the appropriate calculation should be. This is an example, another illustrative example of future and historical lost profits. You can see that the damaging act occurred in this chart on year 2. In year 6 that we have the data trial, or in this case, the data measurement. So anything from year 2 to year 6, we're going to apply a pre-judgment interest rate. Anything past year 6 out through year 10, we're going to present value back through year 6. So this is another good illustrative example to kind of help, or at least refer to when it comes to historical and future lost profits. One of the most common mistakes that I see in my line of work when working with the underlying client and sometimes working with counsel is that they think it's lost sales. So I've had multiple times where a client might come up to me and say, Zach, I've lost 20, 30, 40, whatever the number might be in sales. And, can you calculate this and can you give an opinion on it? Well, that's not the right calculation. There's associated expenses that go along with those sales, and the appropriate calculation is lost profits. So you need to consider the costs that are associated with those lost sales. Now, I mentioned before there's a but-for and there's an actual scenario. We calculate profits for both scenarios, and the difference between both the profits from those scenarios is lost profits. Now, when it comes to computing profits for the but-for scenario and for the actual scenario, how to get the profits or the profit number that we're looking for, it's revenue minus variable costs. So in our calculation, we only consider the variable costs that are associated with this. We do not consider any of the fixed costs. We know that variable costs will fluctuate with revenue. So as revenue goes up, variable costs will go up. As revenue goes down, variable costs will go down. Fixed costs, on the other hand, do not fluctuate with revenue. They stay the same. So regardless of whether revenue goes up or goes down, fixed costs are going to stay the same. A common example of fixed costs is rent. So for each of you who work at a law firm or whatever company you work for, you probably have some type of office rent. Regardless if your company's doing great or poorly, rent's most likely going to be the same. So that's a big something that we need to really consider when we do our work. This is a very highly contested battleground issue. I'll go more into this topic in a bit.
We have a question from William Ashkenazi, who asked if you could please discuss lost profits versus lost revenue and the effect of contract limitation clauses with prime, I believe it's prime subcontractors he's referring to.
Sure. When it comes to some of the contractors, I would have to probably talk offline with you on that. I'm not sure if I can give you a clear and concise answer right now. I know in some cases there can be lost revenue when it comes to construction claims. The majority of the calculations, at least what I'm trying to describe here today, is lost profits. It would probably take me a bit of time to kind of go through both. So if it makes sense, why don't you shoot me an email or give me a call after this presentation, and I'd be happy to answer that question for you. So some of the common battleground issues that we see in our line of work, the first being revenue projections and variable and fixed cost analysis. I'm going to go into that in a bit. Some of the other ones that are more common, I mentioned the duration of the damage period, how it can vary amongst each of the experts, especially when it comes to when the damage period ends. I talked a bit about discount rates, cost of capitals that we use when we are present valuing back future lost profits. The next one, sources of information. I find this to be an interesting battleground issue. Some of it can be preventable, some of it can't. A lot of times, one expert, doesn't matter if it's on the plaintiff side or the defense side, might not get all the information through disclosure or might not have access to management versus the other expert, which might have access to all that. And we can commonly see a large difference in lost profits calculation that from each expert based on the type of information or the quality of information that they have. And that's not uncommon. Sometimes we get way too much information. And having too much information, when I'm looking at 6 different formatting versions of a projection or a financial statement, I'm not quite sure which version to use or which iteration to use. So one expert might use iteration 4 because that's all that they have, and the other expert might use iteration 6. And that can, if there's differences in the iterations, that can lead to a difference in the opinion as well. So that's something to keep in mind from a counsel's perspective. And I'll go into this a bit, but help us figure out what's the best source of information, what's the latest and greatest information, because that'll help kind of clear up a lot of these battleground issues, especially if there's a difference in what the experts are relying upon.
So financial statements are the best source of information you can have?
They can be. Yeah, they certainly can be. I mean, as an accountant, I love looking at an income statement or a balance sheet. There's times where, we do a number of construction type cases where we look at rent rolls and other construction reports, and that could be a really good source of information. Taking a look at, we look at patents or trademarks, there's a lot of other type of royalty information that we'll take a look at. But yeah, I don't think there's ever a wrong reason or a bad reason not to look at a financial statement. Certainly there's accounting adjustments between certain experts, meaning there might be a difference in the debits or credits between the experts or the information that we're using. And certainly the assumptions, and the assumptions is such a wide variety of a topic. There could be assumptions on every little detail of the analysis that I do. So, but that typically can be a common battleground issue, excuse me. All right, moving on to the revenue projections. This is the first main issue that we're going to talk about today. And at the end of the day, you have to remember that revenue, or at least projecting revenue, is a very subjective analysis. And what I mean by that is if you put 10 experts in a room, you're going to get 10 different answers for the most part. And especially as you go out in length, right? So, if you're looking at projection year 1, it might not be that much different between each expert. Once you get out to year 5 and year 10, year 15 and 20, if you go out that far, the differences are probably going to be magnified just because of the trajectory of where the experts are projecting revenue. So something to keep in mind. I don't think there's any right or wrong way to project revenue. There's no good method or bad method. I think depending on the case, depending on the facts and the circumstances and the documentation in the record, I think there is sometimes a better method to use or a more appropriate method than not. But I couldn't be able to objectively answer that question until I see the facts and circumstances of the case and I see what the underlying documentation is that's in the record. So, when I get documents and when I take a look at what's in the record, I have several questions for counsel. You guys can help me walk through what each of the documents are, walk me through what the latest and greatest version of those documents are, because that'll help me at the end of the day really give a good analysis and a good opinion that's supported by good, credible evidence. And if you get experts to disagree, a lot of times it does come down to the interpretation of the documents or the documents that are provided to each expert. In terms of the sources of the projections, I love getting projections that were prepared prior to the damaging act. So if the damaging act happened today, if a projection was prepared last month, that's usually a pretty good source of information. The company typically doesn't have any idea that the damaging act is going to occur in the future. They have no litigation in mind. They're just going about their everyday business and trying to figure out what they're going to do going forward. That's usually a pretty good source of information. And one of the things I'd like to do too is take a look at past budgets and projections. For example, I might want to take a look at the 2011 and 2012 and 2013 and so on projections, because I want to compare how they projected in years past and see how that compares to what they actually did. If the company is pretty good at projecting when it comes to their revenue and their expense projections, and whatever they project, they pretty much do during the course of that year, that gives me a good comfort and lends me to believe that these projections are pretty credible. Versus if the company is widely off on historical projections versus what they actually did, that would tend to make me believe that these projections might not be as credible as they might. At least I was hoping they would be. Sometimes you can get projections that happen after the damaging event. Could be a day, 5 days, a month, a year. These projections can still be useful, but they should be scrutinized. And the reason I said they should be scrutinized is because typically these projections were prepared with litigation in mind, knowing that the damaging event occurred. And some of these CFO or controllers that work at these companies know that the higher projection they can get, or at least create, there's a chance for higher lost profits down the road. So if I'd like at these, I'm not saying they're a bad source of information. I would just scrutinize them and be careful with them. From my standpoint, I'd want to talk to the person who prepared it and ask them a number of questions as to what the assumptions and underlying facts that went into it. Certainly you can discuss with the company management on any type of document that you get. I think that's always useful. To the extent that don't prepare projections, you sit down with the CFO or the controller, and counsel can help facilitate that meeting. Sit down with them and ask them questions as to what they think they're going to do in revenues going forward or expenses going forward. That's usually a pretty good source and pretty credible because it's coming directly from the person that's in charge of the books and records and the financial department at these companies. You could also take a look at market data and industry data. Sometimes market data could be a very, very good source of information. You know, we have a number of databases out there that have hundreds of pages worth of information that talk about growth rates and industry trends, talk about information regarding the demographics and geographics of a particular industry. So to the extent that that's comparable, that could be a really good source of information as to how to figure out how to project revenue. And certainly we can do the own analysis ourselves by taking a look at historical growth rates in the company, taking a look at the historical financial information, and using that as a proxy to project out forward.
How much does the economy play in your projections? How do you factor in sort of what today's economy is versus the future economy?
Great question. So a lot of times in our industry reports and our economic research, we'll look up, here, I'll jump forward. Go forward a couple slides. So you mentioned the economy and the market data that we get. It certainly plays a big role into it. And this is actually a real life case that we did a couple of years ago. And the picture I have on this case is from an industry economic report that we get. I know it's a little snippet, it's just for the key statistics that we have, but we can see in that little box that in this industry and in this particular market, they expected 2.2% growth in revenue going forward. And you can see in the chart below, what I had is on the bottom row, market average growth rate, and you can see a 2.2% growth going forward. Now, go up to the row above it, I'm looking at a company prepared projection that has growth rates of 6.2%, 5.8%, and 4%. I mean, that's substantially higher than what the market is saying. So in a case like this, you know, if I have a disconnect between what the company's saying and what the market or the economy is saying, I need to reconcile that difference. The first thing that I would do is go back to the company and want to speak to them as to, look, hey, we've got a disconnect here. I've got data out here and information that suggests that this is not going to grow as fast as you think it's going to grow. And you need to walk me through your thought process as to why you used a 6% and a 5% growth rate. The other thing that I would do is go back and take a look at other market data. If there's other, we use IBISWorld a lot and some other databases. I might see what else is out there, some other industry reports, and see how that compares to some of the data that I already pulled. In terms of how the economy can also factor into our analysis, other than just projections, the discount rates that we use are heavily based on what the economic trends are at that point in time and what they're going to be down the road. So when we're present valuing back future lost profits, that's certainly an area which can be affected by the economy.
Someone asked if they could see the slide deck, and I assume you're seeing it now as Zach goes through his presentation, but it'll be available for you to have after the presentation's over. So that'll be available for you then.
Yeah, and if for any reason anyone can't get the slide deck from downloading from here, feel free to reach out to me or Danny, anyone at Ellin Tucker, the Daily Record. I'm sure they'd be happy to send you a copy of the PowerPoint slides. So I have a chart here. First continue along with the presentation. I have a chart here which has method 1 and method 2. So we can see in this case the damaging act occurred in year 2. I've got projections prepared prior to the damaging act, and I have projections that were prepared after the damaging act. I I mentioned before, I'd like to see projections prepared in the normal course of business before the damaging act. If you get both, compare them. And certainly both you need to scrutinize. You need to go through with the company's CFO and controller, understand what goes into those projections. I had a case a number of years ago I want to share that the company was a very, the CEO and the CFO were very number savvy, and they had frequently prepared projections and had a lot of support that went into those projections. We had gotten projections from these guys probably about a week or two before this damaging act occurred. And we went through the projections with these guys. They were very helpful in understanding the assumptions and the underlying data that was all put into it. And the projections themselves were really well thought out. In this case, we used the projections in our analysis, and they were very, very credible. And the clients were very successful with their case because of how credible and how well thought out their projections were. So as an expert, we are assumed to scrutinize. And certainly when we get something from a client, we want to take a look at it and understand it. And sometimes that means speaking with the client. I mentioned before that when we get from documents from the client, it's important for us to understand the underlying assumptions and information that goes into it. And take the box on the right of the slide. We have a top chart and a bottom chart. If I'm getting these type of projections from a client, I want to know the underlying assumptions. For example, how did you come up with the current expected price points for widget A, B, and C? I want to know, how did you come up with the expected number of units? Like, give me some document, show me some kind of trend that supports these numbers. And in this case, this example, this is a real-life example based on the same set of facts. The first expert used the top chart to project out revenue for 1 year. And he went through, widget A, B, and C, did his whole calculation, and came to a total revenue amount of $5,090,000. And the second expert used the same underlying facts and data, did a different methodology, and just used historical growth rates. The average growth rate for the last 2 years was 5%. And he applied that 5% to use for future growth and came out to a revenue amount of $4.7 million. So just based on the different methods used by the experts, you have one at $5 million, you have one at $4.7 million. That's over a $300,000 difference just in the first year, and solely because each expert used different methodology. The key with this, and when this comes to this kind of battleground, is who can defend it more? Who's got more support and more evidence, and what is the appropriate method to use at that point in time? There's no right or wrong, but in some cases like this, there might be an appropriate method that was more appropriate based on the facts and circumstance of the case. When it comes to projecting revenue without getting anything from the companies, such as like budgets or projections, as experts, we can do our own analysis as to how we're going to project out going forward. We can look at historical growth rates. Maybe take a 1 year, 3 year, 5 year average from the last couple of years, take a simple average or a geometric average, a median, what it might be, and use that as a proxy going forward. We could also take a look at competitor growth rates. To the extent that a subject company's competitors issue public filing in terms of their financial information, or we just so happen to stumble upon information from a competitor, we can take a look at their growth rates and trends and see how that compares to our company, and a lot of times maybe even use it to figure out what our company is going to do going forward. We could use stats or regression models. I think pretty much everybody on this call at some point or another has taken some type of stats or algebra class where you've had to do regression models and things like that, maybe in high school or college. Our models are certainly a little bit more sophisticated than what we all did in 9th grade algebra, but we can use these regression models to project out revenue in these scenarios for a company going forward. And we've had a lot of success with this in the past, and it can be a really good source of information and analysis for us. I certainly mentioned market data and industry reports beforehand, and certainly the other way that we could help is through deposition. There's a lot of times where we're not getting the required information that we need to be able to project out revenue, or there's no documentation in the record that would give us any idea as to what future revenue is going to be. So sometimes it makes sense to have a 30B6 deposition where you have the corporate designee or the CFO sit down on the record, and we can ask us directly, but ask the questions as to what future revenue is going to be, what expenses are going to be, so on and so forth. It could be a tedious task, be a very time-consuming task, but at the end of the day, it could be pretty useful and pretty helpful in getting the information and the evidence that we need to do our own work. We kind of touched on the slide a little bit earlier about the market stuff, market data. Be wary, market data sometimes can differ than the company information that we're getting, so be prepared to reconcile that difference. And counsel can certainly help in the process in seeing if any other information from the company is available, so we can compare and contrast and figure out the difference between both. The last slide I have on revenue projections is a real example of differences between each expert. The first expert prepared, used company-prepared projections, used higher growth rates than the second expert, which used market data. And you can see at the end of the day, they're about $1 million off from a 3-year total in their revenue projections. Without even considering expenses or anything else, you're already $1 million off. So this is definitely something that can lead to differing results between the experts, and certainly be a battleground issue. Especially if the farther off you are, and experts are different in their opinions. It's revenue projections and things like these which are really honed in on and become battleground issues where you're trying to support your opinion, and you've got a lot of documents going here and there. So
you said there's no right or wrong way to do these projections, but there seems to be an aggressive and conservative way to do these projections. Is there one that when you do yours, is there one you favor or you prefer?
Yeah. So in terms of aggressive and conservative, I certainly err on the side of conservative. In my opinion, it's better to be conservative than aggressive. I can support a conservative opinion more, but again, each case calls for something different. So, you do some lost profits work for a startup, and startups have wild projections where they're going to triple and quadruple in size in a few years, and defending that can be a challenge. So, depending on the case. I've certainly seen other experts outside people at Ellin & Tucker be aggressive and conservative and had success with it. I don't think there's a right or wrong, but from my standpoint, I typically try to err on the conservative side when it comes to these things. All right, so let's jump into fixed cost. We've got about 20 or so minutes left. Certainly want to give at the end some time for some Q&A, but we mentioned before that the calculation of lost profits compares the but-for and the actual scenario. And within each of those scenarios, we calculate the profits, and it's revenue minus variable cost. The chart to the right is a great example of the differences between variable and fixed costs. As revenue goes up, variable costs are going to go up, and it's a direct correlation between both. Fixed costs, on the other hand, you can see in that chart on the bottom, stay the exact same. They don't change. So when we're going through our work, we really try to distinguish what's a variable and what's fixed, because remember, we're only going to subtract the fixed cost from the revenue. Now, I know I'm making this sound like it's pretty clear-cut and pretty concise, but usually determining between fixed and variable isn't so. There's a lot of gray area, and there's a lot of times where we're just not quite sure what the expense would be. So sometimes we utilize what we call a semi-variable or a semi-fixed cost, where we know that a portion of the cost might be variable, and we'll only deduct a portion of what that cost would be. Now, sometimes you get each expense might have elements of both fixed and variable, and it's hard to decipher. Other times you might get these lump sum expenses where it's travel. Or let's just take salaries or compensation, for example. Well, in theory, commissions are pretty much variable, because the more you sell, the more commissions that you get. But at the same time, your salaries usually aren't variable, or they can be, but some of them can be very fixed in nature. So there could be elements of both. Obviously, some can be variable, some can be fixed, but other examples might not be as clear-cut, and we use the semi-variable, semi-fixed analysis and had success with it in the past. So what are the different ways to determine variable and fixed? First way, and I highly recommend it, is to sit down with the CFO, the controller, someone at the company who can speak to these expenses. As counsel or as the attorney, please help facilitate a meeting like that, or sometimes either through a deposition if we can't get a meeting. Usually they have intimate knowledge of their books and records. And I want to make note that sometimes these expenses, we could have thousands and thousands of expenses to take a look at. And there could be lots of different line items that we need to do the work for. So this could be a very tedious and time-consuming process. And I just want to make everyone aware of that this is usually a very time-consuming task, but it's required for us to give a bulletproof and an evidence-supported opinion. We could take a look at some historical financial statements and do some common size analysis. That's typically when we take a look at expenses and see how they fluctuate with revenue. Look at maybe the previous 3 or 5 years and help determine that way. Market data and use of an industry expert are certainly something or items that we can use. They can be useful, but they have to be comparable to the company. And I want to make a note that anytime that you use market data or industry data, you're probably going to get the issue or the scrutiny from the other side as to whether or not it's comparable. So just be worrisome of that. If you get a projection from the company, and they've got all their expenses lined out, one of the things that I want to do is talk to them. Before I talk to them, I'll probably do some common size analysis, do my own analysis, and before I walk into that meeting, I have a general idea as to whether each expense is variable or fixed. And I want to talk with the CFO or the controller or whoever it might be and see if they agree or disagree. If they agree, great. If they disagree, let's talk about it. Let's come to a conclusion. It's also important to get a pretty good understanding in terms of what each expense is. You might get 10 different travel expenses or meals and entertainment expense, different accounts. So what is each account? What goes into what? Why is there 10 different types of these accounts? That kind of stuff we're going to need to have information for. Because at the end of the day, it's our opinion, it's our report. If we're testifying on it, we got to be able to answer all those questions as if we did it. So that's something that we are certainly aware of as we're going through the analysis process. If we don't get projections from the company, one of the things that we're able to do is what I like to call margin analysis. We'll take a look at what each expense is as a percent of revenue in previous years. Take whatever that margin might be and apply it to future revenue if we know that. So for example, if salaries has historically been around 10% of revenue, and we know it's a variable cost, we can use that 10% and multiply it by the future revenue of 10 million, as we see on this chart, to get down to a total salary amount of 1 million. And the same thing in year 2, where it's 15 million, we get down to 1.5 million. Now, as I mentioned before, some of these might be semi-variable, so it's not as clear cut. And obviously we have rent and management fee, which in this case we determined to be fixed, so we don't include that in our future analysis because they're not something that's going to be subtracted at the end of the day. We had a case that occurred about a year or so ago, interesting case where we took a simple average of historical margin for the expenses and used that as a proxy for expenses going forward, the same type of analysis that you see here in this chart. Another expert came in and was saying that we didn't use the right kind of average or differed with us. Maybe the median was better rather than the average. So even some of the simpler, taking an average, how many years worth of average do you take to use a median? Do you take a simple average or a geometric average? That certainly can be a battleground issue, and in this case it was. I think this expert was a couple tenths of a percentage point different than what we used, but it ended up being a couple $1 million difference in total lost profit. So even something as small as a couple tenths of a percent can have a meaningful impact or a very substantial impact at the end of the day. So just be aware of that and cognizant of that. I mentioned market data before. This is another example of some of the market data that we get. With any type of analysis, make sure it's comparable. A lot of times these industry reports will explain what each expense is going forward, at least what a company can expect going forward based on maybe some of the larger competitors in the market or some of the larger players in the market. We had a case a couple of years ago where it was similar to a medical device case, and the other expert was using industry data that was not comparable at all. They were using things like food and plants and shrubbery industries and trying to compare it to a medical device. And certainly we scrutinized that and critiqued that. The data wasn't very good data. It wasn't comparable, and that didn't end well for that expert. So if you're going to use industry stuff and market stuff, make sure it's comparable and you're able to defend it from its comparability. So an example as to how experts can be different and certainly how it could be a drastic impact. The bottom chart of this slide, we have the first expert, which uses a variable cost margin of 40%. All in all, for the 5-year projection, he concludes variable costs of $24 million. The second expert uses a variable cost margin of 55%, so it's 15% more. Throughout the course of his analysis, variable cost total, $33 million. Now we have a $9 million difference in profits as a result, simply because the variable cost margin that was used going forward was 15% different. So this is not uncommon. So when it comes to determining what is a fixed and what is a variable cost, these type of things can happen all the time where it leads to drastic differences in each expert. And a lot of these times it comes down to one or two different issues. So just be worrisome of that. As counsel, challenge your expert. Talk to me as to what are the vulnerabilities in my report. What are the issues? What do I not feel as supportive as maybe as I want it to be? And you guys can help us try to get that documentation either through subpoena or interrogatories or whatnot, and help us understand how to make that battleground issue more clear-cut for us, more supportive, and ultimately give a better opinion. Lastly, how can you guys help us? I can't think of a time or a case where I've had all the information, everything I wanted to get right off the bat. Most cases, it's a struggle to get information, or at least struggle to get relevant information. And a lot of times we are putting together analysis that, it's using a bit of information here, a bit of information there, and making assumptions to be able to get to a final answer or an opinion. So sometimes you guys have a large document pool or database, either through like relativity or concordance or some other softwares. I know we've used that in the past with a lot of cases. If you guys have, the ability to give us guest access to them, we can go through the documents that you've received, and determine which ones are relevant for us and which ones are not. So we're a little bit more efficient at it probably than you guys are, because we've been doing this for a long time. That's certainly a method that we can go about it. To the extent that doesn't exist, and you want to give us the documents because you have to go through it, and so we certainly can work with you and getting a document request list, or at least kind of describing the type of information that we're looking for. And this is a flowing process, and there's times where we might get a piece of information, and that causes us to think, all right, well, if we got this, and there's got to be something else out there. So work with us in the process and help us, through any means necessary to get what we need to finish our opinion. Certainly can work with you guys in giving you and helping you with subpoenas. We've actually used interrogatory questions in the past to the extent that we're not getting the financial information that we need. We'll use interrogatory questions, trying to figure out what future revenues are going to be, or variable or fixed costs are. That's something that we've had a lot of success with in the past, especially if there's just not a lot of relevant documentation that's in the record. Sometimes in these cases there might be multiple experts or multiple clients, people at play, or at least important parties. Facilitating conference calls where we meet everybody, we talk about some of the assumptions and their knowledge in the case to help our opinion is helpful. So making those calls for us, we're aware of their discoverability issues in a lot of these cases. We're always aware of the federal and the state rules. We want to maintain privilege, so no drafts or no communications are discoverable. So we certainly want to go through those channels and those means. Just help facilitate some of that stuff. It's useful if we're working for another expert and they found some documents in the record that they know that might be helpful for us. Setting a meeting or a call is a good way to kind of share that knowledge, share that information, so both experts can give a more bulletproof opinion when it's all said and done.
How often are you updating your projections throughout the process? Is there, as new information comes in, you keep updating it, or is there you just say this is it and we're going to go with that?
We certainly update as we go. I want to make clear that we never have any drafts, either regardless of a federal or a state case. We never have drafts, draft reports, or draft models. Everything we just write over it. A lot of times in these cases we'll get engaged and we have 10% of the documents that we need, and we'll prepare a projection based on what we have, and then it could be, 100 iterations down the road. We've changed our projections and our analysis 100 times because of new information that comes in or more information that we learned, throughout the course of the case. So
You said you have 10% of the documents that you need most of the time?
I'm saying 10%, but it can be as little as 10 or 20% up front, and then as the case goes on, we can get obviously more documents. But I can't remember the last time I've had 100% of the documents that I needed to start a case. A lot of times either the stuff doesn't exist or it just hasn't been disclosed yet. So
what happens when a client is upset with your projections?
We'll meet with them. We'll talk with them. In terms of being upset, look, at the end of the day, we have to give our opinion a value. I can't have any bias or any independence issues with my opinion, and I stick to that. So if a client is upset, I'll talk him through it. I'll get his input. I'll see if that changes anything. But at the end of the day, this is my opinion. So,
what's the biggest misconception you think either lawyers or their clients have about what you do in your process?
I think sometimes it takes longer for the process to happen. When you guys give me thousands and thousands of documents to go through, I got to go through each one because my biggest fear is missing an important document. And issuing a report based on that would be different if I had one or two or three different documents. That's my biggest fear. But in terms of what else would you guys need to know? This is a fluid process. Our reports and our opinions might change over time. So get us involved early. I don't like it when you guys call and you give me a week to do my work. It just doesn't allow for all the analysis to be done. Shortcuts have to be taken sometimes. So just the earlier you can get us involved in the process, I'd say the better. So,
any more questions from those listening in? Anything else you want to ask Zach while he's here?
I do want to point out there's one more thing that depositions I know I mentioned a couple times. To the extent that you can get us involved in depositions, if you're having a corporate designee deposition or some other deposition maybe for the opposing expert, have us come to it if we're available and it's relevant. We can certainly prepare questions beforehand for you, but to the extent that we're all sitting in the same room and I'm listening to what the person being deposed is saying, I might be able to ask or tell you some questions to ask with my financial knowledge that would be relevant for me and maybe even for you when you try to build your case as well. So that's another conversation that I like to have before any depositions are set. Let's put them on the calendar. Let's talk about it beforehand and how we're going to approach it from my standpoint in terms of getting a report and an analysis finished. So
we talk about the length of time for the cases. Are we talking about it takes you a year to do these analyses?
Oh, yeah, it could be multiple years to do some of these. Other times it's like, look, we can get it done in 2 or 3 weeks. So and that may be the only part of the work that we do. But a lot of times we'll prepare a report, and you guys know, and maybe unless you're in the Rocket Docket down in Virginia, a lot of these cases can be drawn out. So it's like you pick it up for a few months, you're working on it feverishly, you get a report done, you get your depositions done, and then it goes away for a few months until trial's scheduled, and you got to relearn it all again. So that's not an uncommon issue. So if I haven't looked at something in a few months, I probably need to go over my notes, go over the report, kind of study it a little bit more, so I get back up to speed with everything.
One last call for questions. As Zach said, you can reach out to him. He'd be happy to take your questions. His email address was part of the presentation. And I guess I'd like to thank Zach for his presentation today. Information from the webinar is available in handouts you can now download. Also, the webinar will be posted on YouTube and accessible from both Ellin Tucker and the Daily Records websites. Thank you all very much. Have a great day.